Consumer behaviors are changing. Indians have started paying for convenience. If India today has to become a developed country by 2047, these 900 billion people have to emerge out of poverty.
What are the kind of companies you're meeting and what have they achieved?
I went to NBC for an interview and they asked me, what do you want to do? And I put together a roadmap of investing $5 billion in India. They laughed and threw me out. No entrepreneurial journey is a straight line. It's full of massive amount of curveballs. We act like professional spouses of our founders. It's not even a 20-year journey, it's a 50-year journey. So my job is to make sure companies don't fail, but we will work on that a lot more.
How has that evolved?
While I was doing my chartered accountancy, I realized that I had a flair towards investments and business building. And that was my first brush towards investments, and I loved that. The idea was to get your hands dirty and actually help build those operations. We did all of that, and that was very fascinating.
What are those?
I think
Hello. Before we get started with this episode, I quickly wanted to share that we are now a part of
01 Network by Zerodha.
Thank you so much for watching. Welcome to the Indian Silicon Valley podcast. I'm your host, Jivraj, and today I have with me an extremely special guest. This person has been a veteran in the Indian venture capital ecosystem. Join me in welcoming Mr. Pankaj Makkar, who is the managing director of Bertelsmann India Investments. Thank you so much, Pankaj, for joining me today.
thank you very much. Super excited to be here. And we've been following your podcast for a very long period of time. My team and I are avid followers of all the work that you do. So super excited to be here and look forward to the conversation.
Thank you so much. That means a lot coming from you. I'm so excited for this because, as we were talking briefly, the structure that you have as a firm is very, very exciting, unique, special to what you do, and that enables you to do such a wide variety of deep work, which is very uncommon, right? I want to understand the structure, but I want to understand and start from your journey. You're a CA who went to business school, who joins this large group and then comes to lead India Investments and has been there ever since for the last 15, 16 years. How does that happen? Like, how do you navigate your life in a way to get to like venture capital early, reasonably, right?
Yeah.
At like 28, 29, if I'm not wrong. And then you've done that for the last 15, 16 years. What is that context?
It's a very interesting story, and I do think that there are certain life choices I kind of took early on, which probably led me here, and I'm super excited and proud of a lot of the choices. So you're right. I did my chartered accountancy and my undergrad from Delhi, and while I was doing my chartered accountancy, I realized that I had a flair towards investments and business building. So I started working on the consulting side, business consulting side, in my chartered accountancy firm, which incidentally was owned by an uncle of mine. So I started working in that department, and I started working with a client of ours called Usahategas. Now, we worked with them on a bunch of projects on the internet side. At that time, if you remember, Sifi used to be there, which would sell retail internet packets. We wanted to set up something like that. So I worked with them on some of those topics. And as soon as I finished my chartered accountancy, they gave me an offer to come on the investment side and start building some of their businesses in India. Later, did I realize that Usahategas is like the Tatas of Malaysia. At that time, I was probably 21. I did not realize that. But once I joined them, I realized this was a massive group. They had businesses in real estate, hospitality, power, oil and gas, media, telecom, satellites, etc., etc. How large conglomerates are, and the idea was to launch or invest in businesses in sectors where the group operated in Malaysia. So between the age of 21 to probably 26, I ended up working in the investment team there, and it was a very small investment team where we ended up making a lot of these investments into these sectors, whether it's in radio, DTH, television channels, satellites, real estate, hospitality, etc., etc. And while the group was strategic in mindset, a lot of the sectors where we were investing, they had FDI restrictions in India, and therefore by regulations we ended up acting like private equity players versus strategic players, because we could not own companies. And that was my first brush in towards investments, and I loved that. The other thing was because we were strategic in our mindset, at least, even if we were not doing those kind of deals, the idea was to get your hands dirty and actually help build those operations. So that was a very big difference where we ended up working very deep in trying to build. It could be the HR topics, it could be hiring, firing, marketing, etc., etc. We did all of that, and that was very fascinating. Um, after doing that for about, I would say, 6 years, I did got an opportunity to go to HBS. I went to the US, and once I was graduating out of the US, I was looking for similar type of groups which had large businesses in other parts of the world but did not have big presence in India, Asia, and so on. And Bertelsmann fitted that DNA very well. The second thing I was looking for was companies which are very entrepreneurial, and then that they can give that kind of mandate to people like me, young people like me. I was 20, 8 and a half at that time. And going, I remember I in fact went to NBC for an interview, and they asked me, what do you want to do? And I put together a roadmap of investing $5 billion in India.
Oh, wow.
They laughed and threw me out. Right? Of course, that was a stupid idea. I think the idea
Yeah.
itself was good, but a 28-year-old kid from Harvard who they don't know,
Yeah.
going and pitching a $5 billion investment uh, was probably the wrong concept. But when I started talking to Bertelsmann and we started talking about building businesses piece by piece, that resonated very well with them. And Bertelsmann as a group is very highly regarded in businesses that they are in. We are leaders in a lot of businesses, whether it's Penguin Random House, in our books business, music, we own BMG. All of these are very iconic brands.
Yeah.
So the synergy between what I wanted to do versus what Bertelsmann stood for, that was very clear. I joined them in 2009. That was in the middle of the financial crisis. So we took a couple of years to refine our strategy for India. And at that time, the financial crisis also got over. But in 2011, I got that mandate from Bertelsmann to come to India to set up Bertelsmann in the country. That particular component had two parts to it. The first was we have certain operating businesses in India, Penguin Random House in our books business, Fremantle where we do in India, X Factor, India's Got Talent, Indian Idol, etc. A lot of the shows which hopefully you and your audience would be kind of watching as well. And the idea was how do we take some of our existing divisions and grow them and make them bigger.
Sure.
And number two topic was how do we launch newer businesses for Bertelsmann. One of the businesses that Bertelsmann has globally is Bertelsmann Investments, which is a large venture capital business that the group owns. We decided in 2012-13 that we should bring that to India. India at that time, we had already started seeing the first level success coming out of venture capital as an industry. And we thought we should play that in a proactive fashion. So that was the background of how I got into venture capital and started kind of building the brand called BII.
That's amazing. No, what a prolific journey. And for a CA who found his way and then proactively approached it, because there are not many, like, let's say finance people in the finance roles in the
Yeah.
country. So I think that's a phenomenal example and also a lot of proactiveness. Can we maybe also like take another stab at understanding the breadth and the depth of the Bertelsmann group? Because I think that was one of the most astonishing things for me. Like I've also known, being in the ecosystem, that this is a large group, but the size,
Yep.
scale, structure, and then as you were setting up shop, there were enough examples by them. I'm guessing there was an Axel, Sequoia, etc. in the country. How did you think of establishing like maybe a different presence? The stage that you chose was also
Yeah.
very unique to the geography, right? Like
Yeah.
everybody talks about, like, we all know, like, seed. Anybody who's in venture capital will know seed. Series A is very competitive. You've chosen a space which is less competitive, but also difficult to underwrite, etc. So maybe if you can talk about these parallels, the group itself,
Sure.
and then the approach as you were building it out like a decade and plus back, that'll be really helpful.
Sure. No, very interesting question. And these are two questions. Let me answer them one by one.
Yeah.
Bertelsmann as a group, we are 200 years old. So fairly old group. but very relevant group. We are among the top five media services conglomerates on the planet. A lot of the businesses that Bertelsmann own are very iconic. I spoke about Penguin Random House. It's headquartered over in New York. We are Bertelsmann owns that 100% now. Um we Bertelsmann used to own Random House, which globally was number one. In India, we were number two. And Pearson used to own Penguin, which was globally number two, but number one in India. And at a global level, in I think 2020, 2012, I think, if I'm not wrong, we decided to combine both the businesses, and that's where Penguin Random House as a group was born. And over time, we ended up giving exits to Pearson, and therefore now Penguin Random House is 100% owned by Bertelsmann. Similarly, we've had BMG, which is in music. One of the largest businesses for us is RTL Group. What Star would be in India, we would be in Europe. So a lot of TV channels, radio stations, OTT platforms, all of that would be under RTL. We recently merged one of our magazine business called Rural India into RTL because content is becoming, kind of is getting combined online, whether it comes from magazines or whether it comes from television. So it makes sense to kind of combine those two businesses. We have a large printing group. We have a large education group. We are building a healthcare group, and we have a large investments group. And also, and again, we have a large services portfolio also under Arvato. As far as Bertelsmann Investments is concerned, um, we have we have kind of dabbled into venture capital since 1990s in various shape or forms. But it was only in 2005-6 when a lot of our media businesses were getting disrupted by startups. We wanted to understand what was going on, and we wanted, and I think it is the foresight of the Bertelsmann leaders at that time and the family that owns it, which is the Mohn family, that they put together a structure that actually makes a lot of sense. Which is, why don't we put together venture capital business where we will give complete freedom of mandate to the teams on the ground. We will not create a CVC because CVC in general does not make sense. And at the same time, we will make sure that we equip the founders with the right capability in terms of capital, in terms of knowledge and know how that we can kind of provide to them, and also be sufficiently patient with them to build extremely large businesses. With those characteristics in mind, Bertelsmann launched a fund in China, which is called BAI. Uh, we launched a fund in the US. Uh, and those two, in general, ended up being very successful for us. The second set of funds that we ended up launching were the Brazil and the India fund, which is what I started in 2012, 13. And recently we have now started more funds which are focused for Europe and US, with more dedicated topics around AI and others. So I think Bertelsmann in general is very excited about launching funds, but they're all backed by Bertelsmann Capital. The way we end up differentiating ourselves is by being extremely long term and being patient about building businesses, bringing our global capabilities into it, and lastly, trying to give the founders the right amount of space to build business. Being humble, being at the background, all of those are the DNA of Bertelsmann and also, respectively, my team. So I think overall, great place to be. We feel that entrepreneurs can have Bertelsmann as a great partner, which can stand with them through thick and thin. And as you know, and you've been an entrepreneur as well, no entrepreneurial journey is a straight line. It's full of massive amount of curveballs. And if you can build partnership where you can discuss very openly the good and the bad and find solutions, then it is a massive help to entrepreneurs. And that's what we try to do. So it's been a great journey for us. Now, your second question was, how did we think about starting in what I call as early growth, which is Series B, Series C? Now, that's a very interesting story. When I came to India and we started looking at what would be our business model when we launch our fund, the successes we had had in China and in the US were around early stage investing,
Mm.
which is very similar to what Axel, Sequoia at that time, which is now Peak 15, or early stage funds like Bloom,
Mm.
etc., would
Right.
have done. So Bertelsmann was very keen to do something like that.
Yeah.
When we went and spoke to people in the market, most of them told us to do this as well.
Yeah.
However, we had a fairly contrarian view,
Mm.
my team and I. First of all, there was no Series B, Series C fund
Mm.
in India at all, zero.
Yeah.
So when we went and spoke to a lot of founders and we asked them, is there a need for something like this? They said yes.
Yes.
When we spoke to a lot of investors about it who were doing seed and investments, they said, why do you want to pay more for an asset when you can get it cheaper in Series A or seed?
Mm.
It does not make any sense. And globally, Series B, Series C is considered to be the death valley,
Mm.
the VC circuit. So, why do you want to do that? Our belief was, if we use a lot of data to analytically figure out risk in certain businesses, and if we feel that by moving from Series A stage to Series B stage, if the risk has fundamentally come down,
Mm.
then we can price that asset a little higher as Series B valuation. And by virtue of that, pay a higher price, which on a risk adjusted basis, on a
Gives you
portfolio level, will give
dividends.
me the same returns as a seed fund or a Series A fund.
Yeah.
So that was our initial thesis. In paper, it made a lot of sense. Like all entrepreneurs, it was a eureka moment for us. I'm like, we have found gold.
Yeah.
It makes a lot of sense. Let's do it. Uh, but then the question was, would it work out?
Mm.
And I think that's where we took a fairly entrepreneurial plunge to say, listen, let's do it.
Yeah.
And I have to thank my backers at Bertelsmann as LPs. They decided to take that plunge with us
Mm.
and said, okay, it's a new concept. We have not done it. We know that nobody in India has ever done it.
Yeah.
But that's where entrepreneurship comes in. And why don't you do that? So, with that view, we started doing it. Now, given that we were doing a new concept altogether,
Mm.
we decided to do a couple of companies a year. Unlike a lot of other VC funds, which when they raise capital,
There's a lot
they
of
go to their steady state of investments, which let's say in a Series B, Series C today, we do about 6, 7 investments a year.
Mm.
For the first 3, 4 years, we were only doing 2 investments a year.
Mm.
Now, why is that possible? That is possible because we are an evergreen fund and we did not have pressures to deploy.
Correct.
So, like any startup journey, it gave me the ability to do product market fit at smaller scale.
Mm.
I did not have pressures from my LPs to go and deploy capital at high levels and burn all the money and say this is not working.
Yeah.
So I could tweak a lot of the things as an entrepreneur of a fund by getting product market fit right, getting communication right, getting GTM right.
Mm.
All of these things we had to build.
Right.
Like other funds where you would have a ready playbook for a seed fund or a fund, we did not have that luxury.
Yeah.
But once we figured out all of that is working, we then ended up increasing our pace slowly. And by our second fund, now we are at steady state. So, in fact, if you ask me, I call myself as a fund which in our life cycle is at a Series B, Series C stage.
I love that. I was just going to say that your terminology
Yeah.
of the fund description is also very founder like.
Yeah.
GTM, PMF, next stage, steady state. It's not very like sort of like obvious VC like
Yeah.
deals, investments, LPs.
Absolutely.
So I think that distinction is nuanced and very interesting. I in fact want to understand that by the time you meet a company, right, considering that they've reached PMF, if let's say a young founder is talking to you and you have to describe that, right? Like what are the kind of companies you're meeting and what have they achieved that maybe pre-seed seed companies should know of? Like maybe on a founder maturity level, maybe on a company stage level, maybe on a trend level.
Yeah.
What are those?
I think that's a very interesting question. I'm going to give you a slightly longer answer.
Please
Is
do.
Is that okay?
Yes,
I'll give
please.
you a little more examples around it also.
Yes.
So, before we start figuring out what the founder should bring to us, we should have a very clear view of what our risk assessment or risk framework is around which we will evaluate that. In order to come to the risk framework, we need to understand what portfolio construction looks like. And that's the most important topic in my mind. Now, if you are a seed fund or a Series A fund and you have invested in, let's say, 30, 40 companies, 3, 4 of your companies will give you probably 3x, 4x, everything else will probably give you half x to 1x. So overall, you'll end up with that about whatever 4, 5x. I'm not talking about outlier funds of 10x, 20x, etc., etc. I do think that there is some level of luck involved where some companies reach that level, etc. But when you're modeling on a portfolio construction and when you're starting evaluating a company, very difficult to say whether OYO will reach a billion or a 10 billion or a 3 billion in between. Very difficult to do that, right? So you'll take a base case assumption and hope for the best, right? So from that perspective, most of the funds, and when we go to and talk to our LPs, they all expect a 4x return. Any fund you talk to, everybody wants 4x, LPs want 4x, happy with 3x. We know that, right? The best funds may do slightly better than that. Not so good funds will do 2x, yet they'll raise a little bit of money, etc. etc. All of that is true. Now, if in a Series B fund, Series C fund, early growth fund, we have to do the 4x maths, how will it look like? The way it would look like is we have to think about what is our hit rate, what is our mortality, and what is the quantum of hit that we get out of that hit rate. So if today I deploy $100 of capital and 30 of them, 30% of that, or $30 out of 100 go to zero, the 70% balance need to give me 6 to 7x so that on a blended basis I'm back to 4x. If I have to get it on a blended basis, my winners of 70% needs to give me 6, 7x. That means, and I will do pro rata investments throughout their journey, then my investment today, at whatever valuation I'm coming to, my entry value, to the exit, need to be a 10 to 12x return on that first check. So that over time I do pro rata, that comes to 6x, therefore this comes to 4x, therefore we have a life, we have a product market fit with our LPs. That's a portfolio construction. So what do I have to achieve in this? I have to make sure that my mortality rate of my capital is not more than 30%.
Right.
What we have realized is half of that you can't predict. It may happen because suddenly regulation change will happen, new competition will come in, something crazy. So in the very beginning, and that risk we call as unquantifiable risk. The quantifiable risk should not take the mortality rate above 15%. Number two, if that's my narrow margin in which I have to operate, I have to minimize what I call as binary risk. That's my go-to goal. So my job is to make sure, I mean, all the VC's job, people's job is to make sure companies don't fail, but we will work on that a lot more. Now, if I have to make sure my mortality rate is 15% when I'm going in, might even expand because of factors which are unknown to us later on. What we did was we characterized risk in various buckets. Certain risks lead to binary outcomes. Certain risks don't lead to binary outcomes. Let's go through that list. Founder, product / sector risk. Founder is really good in a B2C environment, but he's building an enterprise platform that is not a good fit. That will lead for the company to just go down. Has a high binary risk. It's not a winner take all, but competition may come in. What will happen? Instead of a 20-30% market share, you'll end up with 10% market share. Instead of being the number one company, Zomato, you will be Swiggy or you'll be somebody else, you'll still make money. That risk we're willing to take.
Okay.
So that is not a binary risk.
Sure.
So what we did was in our frameworks, we divided a lot of risk into binary risks and we divide a lot of risk into non-binary risk. And then there are unknowns. Unknowns we can't control. But if there are topics which we think will lead to unknowns An unknown risk may actually materialize to become an actual risk. We rather stay away from it. To give you an example, we did not do any real money gaming in India
Sure.
because we thought, while at that time regulations were not clear, we just did not know which side they will end up.
Sure.
Today, they've come out to be on the negative side.
Hmm.
So we got proven right. On the other hand, very early in our journey, we got an opportunity to invest in Ola. Again, would cabs be under a gray, which was earlier at that gray area, would they become kosher or not? We could not tell. We decided not to play that mobility game. It became okay. But that was an unknown risk for us.
Sure.
Now, that as a concept we can do, where we can leave certain sectors altogether where unknown as a risk is very high. But if I am an Axel today, where my LPs expect me to bet in all the biggest themes that are going in India, and I'm making Axel as an example, I don't know specifically they will do that or not, but a fund like that will end up playing in all the categories and will have to take that risk because their LPs expect them to do that.
Right.
They can't miss out on a big sector.
Yeah, they don't have the freedom or luxury to avoid a sector because they have deployment sort of responsibilities.
Yes, and they have to deploy a lot of money in a lot of companies. I have to deploy larger sum of monies in small set of companies. So I can skip sectors and sectors. Because of that, and my LPs don't expect me to win in every sector. My LPs' key job or my key ask from me is to make sure I give them the 4x back.
Yeah.
If I do it in 5 sectors and I leave the other 5 sectors, they should not care.
Correct.
Right? So from that perspective, I think that is an example of how we played certain sectors and did not play others. Now, as far as these two risks are concerned, and therefore now coming to the question you asked, sorry, I told you I'm going to give you a very long answer and give you a lot of examples around it. When entrepreneurs come to us, we actually tell them, if you don't have product market fit, if you don't have founder product fit, if your product is not one of the top selling products in that category, and you figured out that your user value proposition is fully baked out, you have high binary risk. We are not the right partners. If your technology is not fully built out, we are not the right partner. If you're operating into a product where all of this is worked out, the TAM is very small, but you think you will create now a second product in which the TAM will become 20 times bigger, but then I have to take all of those risks which I otherwise would not have taken, I will not be able to invest.
Can we contextualize some of this with investments that you have made?
Yeah,
Let's say
absolutely.
maybe Hereditary Shiprocket.
No, absolutely. Let's look at Licious as an example.
Let's look at Licious.
Okay.
Yes.
When we invested in Licious, great passion of founders to build an extremely large business. By the time they came to us, they understood the meat and the non-vegetarian market completely. So product founder sector matching was amazing. The product was outstandingly amazing. We tried it, we tested it, we checked customer cohorts, consumer cohorts. That was pretty good. In Bangalore, they were a massive hit.
Category leader in that.
Category leader in that. And at that time, they said they will take our capital and now build a pan-India business. Which is why, by the way, I call my fund as an early growth fund, because I'm giving capital for growth. I'm not giving capital to experiment and build a new product. So, what are the risks that we were taking? Product was amazing, team was amazing, product market fit was there, TAM was there. 4 topics, I'm not taking that risk. I'm taking risk. Will Licious win? Or 5 other people who were building that business in that category, will they win?
Correct. Execution risk.
So, execution risk, competition risk. Will you be able to build moats by virtue of which you will become the largest player in that category? I'm taking macroeconomic risk, whether meat as an industry in itself in India will grow or
Keep
not.
growing or not, yeah. Whether it'll formalize or not.
All of that, right? And lastly, I'm taking an exit risk. Will I be able to even get an exit from this investment ever? So I am taking those 4 risks, and those are non-binary risk in my mind.
Right.
If you don't execute to 100 but execute to 80, I still get an outcome. If five more competition people come, it's not a winner take all market. In marketplace, that's different. But if it's not a winner take all market. Five brands can exist in meat. I'm okay to take that risk.
Got it.
Exit. If you build a big business, you IPO. If you build a slightly smaller business, you sell to a strategic, you sell to a PE who will then take it further. Those are risks we can take. So from our perspective, our ability to build a early growth business means that there's a lot of things that we'll not do. There are a lot of risks that we'll not take, and we've figured out a playbook.
So you wouldn't do a social business because that's a winner take all category.
I can do it, but then I will make sure that
Back the
two, three things need to happen with that. Number one, that business requires a lot of capital. We invest $10 to $15 million as a first check. We invest as in the lifetime of that investment, we'll invest to 40, $50 million. But that is not good enough to build a full business. That may require 200, 300, $400 million. So is there enough capital around the table with some of the early guys who also put in money to build that kind of an answer?
Got it.
I will look at the cap table a lot more carefully. Number one. Number two, does the founder have the capability to raise capital? Is he charismatic enough to do it? So that is not just product founder fit, it's a founder capital risk fit also. I will over index on that topic. The third topic I will over index is, does this founder understand blitzscaling? In certain businesses, I don't want founders to blitzscale. Healthcare, education, you build those businesses over decades with trust. I don't want you to blitzscale. You'll just burn money. Nothing will happen. Baiju as example. Just by running the machinery very fast, you don't become iconic names in education and health. Penguin Random House, we have survived for 50 years and more to build that iconic business. Some of the business require that. However, if you are a quick commerce business,
you need the money.
You need to blitzscale. So there are businesses where blitzscaling works. And we need to understand that. And lastly, do we think that in this model, what is it that will create that blitzscaling? Where escape velocity will come, we'll think a lot of those things. And wherever we find that is happening, we will invest.
Awesome. That is very, very insightful. Out of curiosity, the landscape in 2012-13 vis-a-vis, let's say, post-2020 has significantly changed. Has your model, theory to invest, entry price, pattern recognition, how has that evolved? Like if you had to do a comparative analysis of, let's say, first 5 years versus the next, can you maybe paint a picture? Because let's say most of the listeners here are aware about the rush, right? Like we are aware about the post 2021 world where startups have gained recognition in the country, but you've been investing way longer than that. So if you had to draw a comparison, what does that look like?
Very interesting question. I think that we are in the third phase of startup / VC evolution in India. The first phase started when the OGs of venture capital and startup world, the good, great founders, the great venture capital investors came to India, started in India, and started building the businesses. So 2007 to 2015, in my mind, is that in that zone. Over there, the key topic was a lot of those businesses were at that time either copycats of Western businesses with massive amount of Indian innovation. These businesses ended up winning. Let's take horizontal e-commerce, not because Flipkart ended up copying Amazon, but they not only copied and got inspired by Amazon, they launched a lot of innovations like cash on delivery, etc., which was needed for India.
Absolutely.
And ended up building great big businesses, etc., and they continue to be very relevant even today. The second stage of businesses came where founders, either from some of these companies or the next set of founders came, some of the established professionals started building businesses. Take Pepperfry, an example. Amrish, unfortunately, was no more. Ashish, they were professionals at eBay, right? And they had built these businesses and they took entrepreneurial plunges. Look at Siddharth, who is a founder of Tribo, McKinsey, Mintra, and then those people took plunges and they started innovating and started thinking about problems that existed in urban India around them. Some of them may have been similar to businesses in the West. Some of them were absolutely new. Oyo, Tribo as a concept did not exist in the rest of the world. Ship Rocket, aggregation of couriers on one end to work with smaller merchants as a concept did not work. That was a problem that Indian merchants faced in India. In the US, USPS and UPS and FedEx to a certain extent had solved that logistics problem. This was unique to India.
Yeah.
Delivery getting built on the back of Amazon, Flipkart, and the e-commerce rush. A lot of payments companies getting built. All of them, in my mind, were the second phase of entrepreneurship, and even VCs ended up backing a lot of those companies because for the first time we were trying to back businesses that were relevant for India, were trying to solve problems which were relevant to founders, and they had seen a lot of them with their own naked eyes, etc. That was the second phase that probably in my mind, again I'm being very loose about it, but went till 2020, 21, 22. And then there's a post COVID world,
Mm.
right? Over there, of course, use of technology, use of online products for users in India, around the world also, but especially in India, went through a dramatical shift massively. And that opened up a lot more opportunities. Indians ever paying convenience fees for products and services was unknown. Yeah. Before COVID. We never thought that we as Indians would even pay a single rupee for convenience. Today, convenience led quick commerce businesses, quick services businesses are taking off in a big way. So, consumer behaviors are changing, and VCs are backing a lot of those topics, which otherwise would have been an alien concept. Now, quick commerce as a concept has not worked anywhere in the world. Yeah. It has worked in India because of three factors. Number one, Indians have started paying for convenience. Number two, we have a cost structure of delivery boys, etc., which is much cheaper than the rest of the world. And number three, we have massive, significant amount of density to make sure that unit economics can work. All of these three things put together may not exist in most probably. I think a lot of such businesses have started becoming possible, and we are seeing massive amount of activity around that topic. Some of the early signs that we are starting to see in topics which are slightly far away. This could be space tech. It could be climate tech. Businesses focused on rural India, the 900 billion people that sit in villages. I'm not talking about tier 2. I'm not talking about tier 4. I'm not talking about tier 5, 6. I'm talking about, I don't know whether you've seen this movie called Swadesh, Shah Rukh Khan's movie, very famous. In that movie, he goes to a village, and in one of the songs, he goes to an even smaller village outside of that village. Yeah. We're talking about that last village. Yeah. If we can reach that last village and make massive development focus there by building a sustaining business, that's massive. If India today has to become a developed country by 2047, these 900 billion people have to emerge out of poverty, have to get access to goods and services. Now, they may not buy an iPhone, but they will buy a phone of 10,000 rupees. They may not buy very expensive stuff otherwise, but they do want entertainment, they want education, they want healthcare, they want basic necessities of food, stationery. Their children wants to have a birthday cake on their birthday, etc. All of those things are missing there. So I do think that, and then we just can't have an urban India model which will just go there and replicate that. Yeah. Paying capacity, distances, logistic challenges, massive amount of innovation is needed to solve all of it. So we are seeing the next crop of companies building a lot of those businesses. And these are very difficult problems to solve, whether it's the deep tech problem in space, whether it's drones, whether it's defense, whether it's biotech, whether it's rural India. These are tough problems. And I do feel that entrepreneurs which end up solving a lot of these problems will build massive value for themselves, for the stakeholders like venture capitalists will back them, but also will make sure that the country moves forward at a pace that we want it to move forward.
Absolutely. No, couldn't be more true and wiser. So for those who are listening, I think this is a very, very important space. But thanks for breaking it down. I think that structure is very, very helpful. Um, Just the last question on maybe the stage of investing, and then we'll go to some more sort of like, let's say, founder insights. You mentioned at the start that a lot of Series B investing is actually analytical. Yeah. But then again, there is this debate of, how VC investing at large is very like there is a scientific element to it, which is the quantitative side, which you spoke about. But then there is the, creative art and qualitative element of it, right? Which is underwriting the founder. By the time you meet a company, I'm guessing the founder has matured, but there's still a long way to go.
Yeah.
Can you help us quantify your framework of thought when it comes to the qualitative and the quantitative side? How much does it matter at your stage? What do you see from a founder traits lens when you meet them, vis-a-vis when you've spent like 5, 7, 10 years with them?
Yeah.
What does that look like in terms of maturity? How much they grow?
Yeah.
Would love to understand this aspect of the business.
Now, smiling because it's a very hotly debated topic in my
Yeah.
team, right?
Okay.
And I'll give you some of the examples of what my team tells me, right? So there are certain risks that we can do a diligence on and get very scientific about them. Let's say we are figuring out whether TAM exists or not. We can do a lot of study, top down, bottom up analysis, etc., etc., and figure out whether the market exists for this business or not. We can go and talk to consumers of this business, and by the time they're coming to Series B, Series C for us, hopefully they have good traction, they have users. So a lot of times we end up talking to 300, 500 customers to understand what is working, what is not working. We would figure out why they are choosing this product over something else. If there are three competitors in the market, what is the share of voice for each one of them, and so on. So I think there's a lot of data that you can collect on the back of which you can take an assessment on competitive positioning. You can figure out within the value chain where does this platform exist and how much value can it capture, what is the right to exist, what is the right to win. And I think we do a lot of that diligence. So in fact, a lot of times our diligence would look very similar to a private equity guy, actually. That's the level of diligence we'll end up doing. And that gives us a lot of data point to make it as scientific as possible. But not everything can be done by science. And that's your question, right? There are things where you need to figure out whether a founder and his DNA and the team and his DNA is backing him. So the funny incident that I remember is that whenever I would meet a founder, I'm talking about probably 5, 7 years back, I would tell my team, oh, this founder I want to back, this founder I don't want to back, right? And they will tell me, they'll ask me, right, how are you making that assessment? Is it just because you have more experience than us and or you have some kind of a crystal ball that you can gaze into and give me the answer? Or you're just looking at the founder's face and say, I don't like his face or I'd like his face? Or what is, I mean, can you break it down for us? And thankfully, the culture that we have at BII is that everybody can ask a question and not let the other person go till they get the answer. So my team did not let me go. And this is not one time, it's happened over times, multiple times. And we ended up telling the team that if I can't find a good quantifiable reason to tell you why this doesn't work for me
On the founder.
on the founder,
Okay.
they will not let me.
Okay.
So, okay. So then we started quantifying and trying to put as much science behind this as possible. So, does the founder have a good vision and a mission that we think he or she will continue doing this for a long period of time? We will meet the founder multiple times, try to understand whether we are able to underwrite the thesis he's doing. If we don't believe in the thesis, we'll tell, okay, we don't believe in the thesis. But by the way, my team has complete freedom to go and talk to 5 more VCs and say, Pankaj, you are 100% wrong. You're not getting it. 5 other VCs believe in this vision. You don't. So, can you get data points to actually push my gut?
Sure.
Over here, I'm saying gut or art or whatever you want to say, versus make it as scientific and objective as possible. Or you can say, you know what, I think this guy is really good, but will he be able to attract and execute on this vision? Because now we believe the vision is great. Will this founder be able to execute on this vision? So how do you look at execution skills? So you do a massive DD on the founder to say what are the skills that he's good at. Number one, you can do a lot of reference checks and get that answer. You can also then start looking at founder minus one, the entire team. Do Is the founder charismatic enough to say that all the people that he's hired are actually better than him, and he's been able to attract that kind of talent. So even if you are not able to buy into his vision, everybody else below him is buying into that vision. That means you are wrong as a VC. This guy has something in him. Go after him or her. Because 5 people who have left Google and Microsoft jobs, and they were getting paid $500,000, are all working for this guy.
Yeah.
So you can't make that statement.
Right.
So please go and think again and come back. Is this guy able to, and hence the people that he's hired, the team, which includes him or him or her, and the team, will be able to execute for the next 2-3 years. No founder has a view of building the business for the next 5-10 years. This is a development, and this is a risk we'll end up taking. Most of the founders, like most of the VCs, and I think of self as a founder and a VC, we have all grown over years. If you would have met me in 2012-13, my answers and my viewpoint and my execution capability would have been very different from today. Same goes for most of the founders also.
Absolutely.
Right? So from that perspective, the only thing we're looking for is, will this team be able to execute for the next 2-3 years? Lastly, will this founder and the team be able to raise capital, or they are talking in some language which is either too technical that the VC will just not get? So while I am able to do this round, the next round will be a big one. And talk a lot on these topics. Now, yes, there is some subjectivity involved here, but at least what we have done is we have made this from a black box to a slightly more while still subjective, but as objective as you can. Conversation that will end up having debates about this topic internally within a team.
Sure.
And then finally kind of choose that. And I do feel that that debate is very, very healthy and is going to do good to our business and is going to be good for the entrepreneur as well.
Absolutely.
The other thing, by the way, which we do a lot is, a lot of times we actually share very detailed feedback to founders on the DDs we have done, not only on the founders' capability or team, but in general.
Sure.
And we feel that founders love the fact that, yes, you may not have funded the guy or that company, and they may not be as excited about that topic, but they appreciate, number one, a lot of hard work you've put in. The fact that you are not saying no, oh, I don't like you, and I'm not giving you any reason. I don't like you because tuck, 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 3 things.
Yeah.
So that something has come out of that conversation. They can work on those. If they believe that that is true,
Correct.
they may say, oh, these guys don't believe. These are fictitious things. I don't understand them. Let's not work on them. But if they actually feel that, oh, some of these insights are interesting, they actually work on it, become better, and they come back and tell us, oh, we did not raise money from you, but guess what? We love that interaction.
Yeah. Absolutely. No, this is amazing. I think very, very helpful. Does any founder come to mind who sort of like within this framework fit well as you were making a decision and then continue to prove you right through the journey?
Right. Would that mean that he grew, or he was already very
No, in
good
your
in his
portfolio,
job?
I mean, in your portfolio and your decision making,
Yeah.
as you thought through some of these frameworks on the founder, with the premise that you set, and then how he or she sort of prove that.
So thankfully, most of my founders, if not all, will fit this criteria. Otherwise, will not have a successful fund.
Fair.
Right.
Yeah,
so
that's
I'm very proud to say that this is working, and because it's working, it's become a framework versus a ad hoc concept.
Fair enough.
And within this, again, there have been founders who over time have moved from good founders to greatness. And there were people who very early on we thought were great and continue to be great, and so on. And therefore, we've had various type of
Sure.
experiences there. And again, over here, being a repeat founder and being a first time founder plays a big role. Let's look at Shiprocket as an example in our portfolio, which is a massive success story. And I am now wowed by Sahil and Gautam and Akshay and the team. When they started building a business, they were great founders, or they were good founders who had put together a good product, but we end up pivoting 2-3 times, right? And not only did their understanding of the market, what consumer or the merchant wants in their case, and the ability to build very great products over time have exponentially become better. Today, I think I would rate Sahil and the team one of the best in the industry, right? And I hope that's the viewpoint of most of the people there. So from that perspective, they were first time founders, and They had a massive learning curve, and that is how it should be for most of the founders. But if you look at some of the second time founders or third time founders, Ashwin Damera of Eruditus comes to my mind, right? He had built Travel Guru, which he then sold to Travelocity, which then got sold to Yatra, and then he started Eruditus. Again, very early on, he knew what he did right, what he did wrong. What he did wrong, he could kind of quickly kind of make some of those changes, and hence, from his perspective, some of the things that I saw coming out were a lot more sorted, and therefore he did not even pivot. In fact, he raised a seed round. He did not raise a round because the company went very fast. He raised a B round, so seed B, then did not raise a C round and raise a D round. The reason he could skip and get escape velocity in an education business, which is not supposed to be bit scaling, was because of probably that maturity.
Absolutely. Well, that's super helpful. Thanks for pointing out those examples. This is also a good time to maybe understand, like, in a lot of your language, you have spoken about your team, right? And I think one thing that I love understanding from both founders and founders of firms like yours, which have scaled really well, is how do you go about building an institution, especially a venture institution, which requires longevity, which is very human first, right? Like the job is very like you have to pass on the learnings, etc. And briefly before we started, again, you were talking about how you're so proud of the team. If you had to just point out to like what makes great venture talent, how do you sort of like pass on the learnings? How do you build ownership in a job where I'm guessing all founders in your portfolio want your time, but you've curated a team that would warrant their time, their insights, their sort of value on the table. So, any insights on building an institution within the realms of venture capital would be really really helpful to sort of gauge.
Sure. Uh, you've asked 3, 4 questions.
Yeah,
Not,
it's a very like long, longish.
Let me try and answer one by one.
Yes.
I think 2, 3 things that in my mind are essential for somebody to build a career in venture capital. Number one is having the ability to understand business models and figure out where are the value gaps, which is basically having a mindset which is not structured with previous topics, previous issues, and that doesn't work. Having that kind of a mindset is very, very important. That for me is the first critical thing I would look at. Otherwise, all the founders that are coming up to you with ideas, you'll not be able to have an open mind when you're thinking on whether that will work or not. You have to imagine that world where this needs to work, traditional structures need to break down, consumer preferences need to change, etc. And if you don't have a free flowing mindset from that perspective, it will not work. The terminology that most of the VC funds give for this type of thinking is first principle thinking. So, first principle thinking needs to be your biggest trade point, number one. Number two topic in my mind is you need to, at least the investment team, but in general, the teams are very small. You need to be a hustler and have a certain level of FOMO. Why do I say that? Funnily, I tell my investment team, you are not an investment team, you are a sales team. In a startup, how we have to go and sell our product, you have to be out in the market and sell. You are a Eureka folk salesman. The only difference is instead of going from door to door and selling your vacuum cleaners and your water purifiers, you are going and sitting in Koramangla Cafe Coffee Day or at the Oberoi Polo Lounge and meeting founders and going and doing deals. If you're sitting in the office, you're wasting time. So have your sales concepts very, very clear and throw them on the investment team, and they should worry if a second salesperson reaches the customer and sells that product better than you do, then there's something wrong. So if you have that mindset that, oh, I'm an investor, I'm sitting in an ivory tower and founders will come in to me and raise and will pitch me an idea and I, oh, what a privileged job I have. At least at BII, we don't have that mindset. We are actually salespeople. And funnily, a lot of times our meetings are not 1 hour long, they're 1.5 hour longs. Because not only do we need to understand the founder's pitch, we will be selling ourselves alongside. It's a core DNA proposition that we have built in the team. When we are entering into a partnership, and I'm hoping, I don't know whether you're married or not. You're not, okay. So as you think of getting married, you will not only go and sell yourself to your spouse, you'll also want to learn a lot about the spouse. And it's a give and take relationship. As we are thinking of becoming, and this is, I've coined that term some 5 7 years back, we act like professional spouses of our founders.
Yeah. This comes out in your GPT as well, by the way.
Yeah. And we are going to be working with them. Again, we are patient capital, so we try to think of that life as 10 to 20 year life. But what I've realized now is I'm highly wrong. It's not 20 years, it's 40 to 50 years. Even if I've exited some of my companies, those founders, their spouses, their families, their children, my children have become so good friends that I don't think this relationship is a 5 10 year journey. It's not even a 20-year journey, it's a 50-year journey. I am thinking on when my founder's kid will get married, where will I be? And whether I'll enjoy on that wedding, whether they're having it in Koramangala or they're having it in Venice, depending on how successful that startup has been. But that's my mindset, right? Sure. So I think some of those kind of things, going back to that question on team, plays a very big role. And lastly, I keep telling my team that the last trait that I want, at least as BII, from my team is you need to be very humble. We are trying to get into the passenger seat of a Ferrari with a sports car driver who's the founder, who's going to drive that car. We are going to have a lot of fun while riding that car, but we're not going to be driving it. We'll not get the acclaim or the fame attached to it. We might get into an accident sometime, and that's where we lose money. Yes. So that analogy is very true, but we are not going to be lifting that trophy in a big way. So, from that perspective, we need to take a role of a passenger or a partner. We are not the main person. And be very helpful, be a navigator, give a lot of support to the founder to do the right business, do the right thing, have very strong governance standards, etc. But at the same time, be extremely humble. So, I think those are the three big traits that I would want my team to have. So that was your first question.
Yes.
Can you repeat some of the other questions?
The others are mostly around culture. Like maybe we can keep it broad.
Yeah.
But if you had to like maybe highlight some of the key things you've done over a period of time.
Yeah,
to
no, it's
establish.
so. By the way, I'm very proud of the culture that we've built. And whenever I meet ex BII people, they all tell me that this stands out for us. The first thing that I realized as when I was building the team and the culture was that in organizations, hopefully the CEO or the founder knows the most, and the most junior most guy may know the least. And it's a top down structure. But in a VC fund, first of all, the number of employees is fairly small. So it's a small team. But along with that, most of the people who are on the ground, my sales team, may know my consumer better than I would. So I need to make sure that I have the ability and the willingness to listen to them the most. And I want to give them the ability to speak the most. So, two, three things very interesting that we did in our offices. And whether you go to my Bangalore office or you go to my Delhi office or Noida office or Gurgaon office, my entire office is made of glass where if you are sitting anywhere in the office, you can see anybody and everybody. Why? We want a flat, transparent, open culture. These three things. My office is designed with that view. If an analyst sitting in a Bay Area, he can see the managing director, then he'll feel he's approachable. When I walk out, I will sit down on the Bay Area, talk to him, etc., etc. This is what founders say. Founders and a lot of the people sit together, work, etc., etc. They don't go and sit in separate cabins. We want to take that kind of a framework there. Number two, we wanted to make sure that everything that we end up discussing, we do it with the full team. Whether that's the finance team, whether that's the marketing team, whether that's the investment team, everybody knows about everything. So that everybody's empowered to kind of do their job. Yeah. And the third topic is we have built very detailed KPIs and OKRs for the team We have something called an investment manual, which is a 50-page book which tells what each person will be doing on a single day,
Wow.
depending on what job they are doing. So we've tried to kind of create significant processes which helps us in onboarding new talent. It helps us in training them. It helps us in figuring out who's responsible to do what job, etc., etc. All of that is very crystal clear. So, and by the way, these are not unique things that we have done. I think that all good organizations, not just VC funds, should be following something like this.
Yeah. No, that's amazing. But I think the articulation structure and the passion with which you've spoken about it goes to show that this is very important and sort of how well you've built it out. For the last bit, I think we've spoken about, let's say, the deployment side. We have spoken about the structural side of VC. I'd love to understand, because you have a unique vantage point because of the global sort of touch point to Bertelsmann as well, how the value additive side to sort of your investments work, right? Like, let's say you've partnered with a company and you are in a position where you are going to partner with them for a really long time.
Yeah.
So how do you think of value add is such a overused term in
It
the
is.
ecosystem. So for the lack of, like, maybe I'll go with terminology, what does portfolio support look like?
Sure.
What are these partnerships materializing into?
A very good question, and I'm gonna probably give you a an example of, not example of the value add, but something that we did which shocked us. In 2012-13, we started the fund, as I told you. 2015-16, we had realized we had got product market fit.
Hmm.
Something was working,
Right.
right? And as founders, you want to know, why is it working?
Right.
What is working,
Right.
but why is it working? So we decided we will reach out to a lot of founders who have taken our money, and we'll reach out to a lot of founders who have not taken our money but met us, and we'll reach out to some of our co-investors. And that is the group that we thought we'll do a survey, and we'll ask them, why did you take Bertelsmann money? Did you take Bertelsmann money because we do a lot of value add? Or our global, oh, this is Bertelsmann, it's very prestigious, etc., so it'll help on the cap table? Did you take money because we were the only fools available to give you money, or we were the ones who gave you the highest valuation? What was it, right? So that we at least know, number one, are we doing a good job? Number two, are we differentiated in any shape or fashion or not? And a lot of the answers that came to us actually shocked me. So again, no surprise, we gave fair valuations, fair investments, ability to do follow-ons, and value add, which is around hiring, strategy, some BD, is all of that is table stakes for top VC funds.
Sure.
Everybody does it.
Right.
So all the founders expect all of this from you. We also do all of that. So no problem. But you can't build a differentiated fund or a moat on the back of any of this. So how do you do it? And we asked them, but then you should have taken money from other people also. No, if it's commoditized,
Yeah.
why did you take money from us? They actually told us that, guys, you felt like partners to us. When we spent a lot of time with you, whether it was the first meeting, you made sure that if it was lunchtime, you ordered food for us. Somebody in your office called us and asked whether you are a vegetarian or not. You cared about us. And over there, we started feeling like partners. When we went into the meeting, you explained what Bertelsmann was. It was not a one-way communication. It was a two-way communication. And we thought, these are people who I can work with for the next 10, 15 years of our lives. When you go into board meetings, you would not ask, Acha, ek bata, last quarter, how much money did you make? No. First of all, are you well? Is your family well? If you're taking that 10, 15, 20, 30-year view, your perspective of how you'll view that partnership would fundamentally change. And that aspect came out very strongly in that view on why people took Bertelsmann money over others, while all the good funds are expected to do that basic work of value add, etc., etc. So keeping all of that in mind, we decided to double down on a lot of these topics. So as we went and built our second fund, third fund, we are very, very patient capital. Patient capital doesn't mean that you don't give us return and we'll be patient about it. No, we want you to build the right business, but we don't have exit pressures.
Sure.
We will exit at the right time with you. But if you are building that business and it makes sense, we don't have compulsions to sell.
Sure.
If you are having issues about businesses, come and talk to me. Call me at 11 o'clock at night. We'll pick up the phone. If you've had a very tough day at work, you don't, as a founder, want to take that baggage home and discuss that with your wife at 11 p.m.
Yeah.
You have other co-founders, you're talking to them. If you want another voice of reason, you want to debate something out, competition and launch a product at a lower price, you're getting worried about it, call us. We will talk about it. I'm not giving you a client, I'm not giving you a business, I'm not changing your revenue by 2x overnight by bringing you BD, etc., etc. We will do all of that using Bertelsmann capability.
But
That is for me a table stakes.
right.
But the ability to be there for the founder, which is where again that topic of professional spouse comes. I am there for you as a founder. I understand your problems. Not all quarters are going to be the same. You'll go through massive amount of anxieties. You'll go massive amount of times when you have to fundraise and things will be difficult. If I can use my power to make your life better in any shape or fashion, I'm a good partner.
Yeah.
That for us is the biggest value add we can provide. And now over 10 years of practicing that, and I did a similar survey some time back in 2012 to 2022 when we were launching the next fund. This aspect came out very strongly. So I was quite happy that whatever we learned from the first survey in 2015, by 2022, we had implemented on that very well.
That's amazing.
So I think that's second point. And then you had a last question also on
Just, I mean, this was the broad, like the value add bit. And I think that is a very, very fitting sort of end. Like if, when VCs like you who build such strong institutions talk about the softer aspects of being true partners to incredible founders who are truly building these great institutions, I think that speaks to the merit of the business.
Absolutely. Look, a lot of the VC people say we are founder first.
Yeah.
Let me tell you, we are not founder first. We are founder fair. If the founder is doing something that we don't believe in, we will not talk about it with the founder in a large board meeting. That is not right. But we will take the founder on the side and have that conversation. Say, listen, yaar, this is not working well.
Sure.
Think about it, deliberate it. Let's have a professional conversation about it. Why don't you try and fix that topic? Most of the founders, if they think we are doing this for their benefit, for the long term and company's benefit, they see reason in it. So I think that's where I would like to kind of wrap this up, that being founder fair and having a very strong concept of fairness, transparency, ability to add value not in harder topics of business topics but also on the softer topics is the need of the hour for our ecosystem. And I would love for other VC funds and founders to kind of take that role.
Yeah. No, that's amazingly articulated. Thank you so much for all your insights. I think the passion, articulation, and structure really stood out for me, and I've had such a refreshing conversation. Thank you so much for all your insights. I'm certain if somebody's waited this long, and many people will, they would have learned a ton from this conversation. Thank you so much. I'm so glad we finally did this.
Thank you very much and really appreciate it, and wishing you all the best.
Thank you so much.
Hello. If you made it this far, you've probably watched the entire episode. And if you've done that, I'm really grateful. I and my team try to put in a lot of effort to ensure that we can bring the best quality content to you. So if you liked the episode, if you watched it thus far, my request to you is to share it with people, to subscribe to the channel, and to ensure that we can keep growing. We are everything and anything only because of you, our listeners. Thank you so much for tuning in. We'll keep bringing to you amazing content. Cheers.